It appears that the Fed just crushed the bulls' hopes and dreams of achieving a soft landing and many rate cuts for 2024. Tesla stock fell over 4% today, continuing to fall in after hours. What's going on? Where does the selling end? And what do you need to know? The Fed Minutes starts off by saying on page 4, quote, over the intermeeting period, some softer than expected data releases appear to lessen the perception among investors that policy may need to tighten further in order to bring inflation down to 2% over time. Market participants also viewed monetary policy communications on balance as pointing to somewhat less restrictive policy than expected. As a result, nominal treasury yields declined significantly, and the expected market implied path for the federal funds rate beyond the next few months shifted downwards, going from 4 rate cuts to 7. Meanwhile, broad equity prices index were boosted by many of the same factors that lower treasury yields, and spreads on investment and speculative grade corporate bonds narrowed. Financing conditions remain modestly restrictive as borrowing costs remain elevated despite declining over the intermeeting period. Now, they go on to say, to even reference the S&P 500, they say broad stock price indexes increased markedly over the intermeeting period, and spreads on investment-grade bonds narrowed modestly. While those on speculative-grade corporate bonds declined more notably, the one-month option implied volatility on the S&P 500 decreased moderately and reached its lowest level since January of 2020. They say bank credit conditions appeared to tighten somewhat over the intermeeting period, but credit to businesses and households generally remained accessible. They say credit conditions for small businesses appeared to have tightened further in recent months. Credit quality remained broadly solid but deteriorated further for some sectors in recent months. The delinquency rate for small business loans continued to tick up in September and was above levels observed just before the pandemic. Credit card delinquency rates also increased further, while delinquency rates on auto loans were little changed in the third quarter. So what you're noticing here is the talk about rate cuts is really gone. They're not talking about rate cuts pretty much at all anymore. The Fed says the risks around the forecast for economic activity were viewed to be tilted to the downside, so we have a greater chance of seeing bad data than good data. In particular, the additional monetary policy tightening that could be put in place if upside in inflation risks were to materialize, with the potential for a greater tightening of financial conditions represented a downside risk to the projection for economic activity. So basically saying if factors in the economy do not continue to improve, they might be forced to raise rates and put more pressure on the economy. Regarding the economic outlook, participants generally judged that in 2024, real GDP growth would cool and the rebalancing of the labor market would continue, with the unemployment rate rising somewhat from its current level. Retail sales growth had stepped down noticeably in October, though a few participants remarked that contacts reported strong sales in November, notably related to holiday spending. Participants mentioned several factors that may contribute to softer consumer spending, including slower growth of labor income and diminishing pandemic-related excess savings. As evidence for the soft landing of the growth of labor demand during 2023, many participants noted the decline in job openings, and a few remarked on the lower quits rate. Several participants noted that the risk that if labor demand were to weaken substantially further, the labor market could transition quickly, keyword quickly, from a gradual easing to a more abrupt downshift in conditions. They're basically saying that if things start to snowball, it could go quickly. And by that, you could rapidly enter a recession. Participants generally perceived a high degree of uncertainty surrounding the economic outlook as an upside risk to both inflation and economic activity. Note, they're saying inflation and economic activity. They're still not dropping inflation. Furthermore, participants observed that after a sharp tightening since the summer, financial conditions had eased over their intermeeting period. Many participants remarked that an easing in financial conditions, bond yields, what is appropriate, could make it more difficult for the committee to reach its inflation goal. And last but certainly not least, participants discussed several risk management considerations that could bear on future policy decisions. Participants saw upside risk to inflation as having diminished, but noted that inflation was still well above the committee's longer run goal and that a risk remained that progress towards price stability would stall. A number of participants highlighted the uncertainty associated with how long a restrictive monetary policy stance would need to be maintained, and pointed to the downside risk to the economy that would be associated with an overly restrictive stance. A few suggested that the committee potentially could face a trade-off between its dual mandate goals in the period ahead. Now, I've heard some analysts and investors say that this is actually a good thing, and it's not. I mean, a trade-off between what? Price stability or maximum employment? What, you're going to let inflation rise and maximum employment stay low, or what? You're going to let maximum employment ease, meaning people lose their jobs, and inflation continue to fall. A trade-off either way is not good. That's specifically not good when our markets have been trading based on a narrative that we're not heading into a recession in 2024. The summary of the Fed minutes today was less rate cuts, potentially a hard landing, and maybe the Fed will need to raise rates again. If not, keep them higher for longer. None of that sounds good for stocks. But here's where things get a little bit tricky, because 10-year Treasury yields actually fell about 2 basis points today, and the markets are still pricing in 6 rate cuts for 2024. So the Fed kind of rug pulled the markets today. And the fact that the S&P really stocks broadly, trading near all-time highs, really puts a lot of pressure on the markets to the downside. That's why we've seen an over 2.5% drop in the Russell 2000 today. The Russell 2000, your small mid-cap stocks, your interest rate sensitive names, are by far the most affected by less rate cuts, greater odds of a recession, and, well, inflation remaining too high for too long. Tesla is also grouped in that category, and that's why Tesla stock fell over 4% today, and even here down in after hours at the time of recording this video. But most importantly, what these Fed minutes are really going to do for the markets is make the data much more important. Tomorrow morning, we will be getting some data. This is the ADP employment change. It's the closest related data report to the non-farm payroll report, which is going to be coming out on Friday. That is your big catalyst of this week. But the ADP employment change is going to tell us a lot. So last month, we had 103,000 job ads. We're expecting 115,000 job ads for the month of December. If this number comes in light, it's going to be a sign that the non-farms are going to come in light. Ultimately, bad data is bad for the markets. If it starts to look like we're potentially heading into a recession, stocks will sell off big time on that. Even though that would likely mean more rate cuts start to get priced into our markets, recessions are always going to bring up more fear than whatever the Fed's policy is going to be. I mean, the S&P 500 fell from August of 2022 through October of 2022 about 20% based on recession fears. The markets are way higher than you were back during those times. So any fears of a recession or a slowdown from here could be especially brutal for our markets. I still believe in the narrative that you want to be in interest rate sensitive names. You want to be in stocks like Tesla that will benefit from rate cuts and or the economy avoiding a recession. But recession and recession fears, totally different things. Whether or not we get 6 months of declining GDP is one thing. Whether we get a bad jobs report that leads markets to say, hey, are we heading into recession? That's completely different. Stocks sell off on recession fears, not the technical recession. By the time you get even 1 month of negative GDP, you're 3 months into potentially a recession. Stocks are already going to be selling off way before then. So yeah, although I'm not super bearish on the markets right now, I do think this Fed minutes report makes it a lot more difficult. As I have said many times here on this channel, I'm actually expecting the SPY and the triple Qs to fall because you've seen a very aggressive rally, and the stocks that control these indexes are Apple, Microsoft, Google, Amazon, Nvidia, those mega cap names that are, in some cases, beyond fully valued. In Apple and Microsoft, they're trading at very high valuations, 2 to 3 times, 5 or 6 times some small cap valuations and where some small cap stocks are. So I'm expecting a pullback in the broader indexes. I'm also expecting a rally in small mid cap interest rate sensitive names, which includes a Tesla. But if the economy starts to get worse and deteriorate, well, you could just see a sell-off in pretty much everything. So I don't really think we know much until we get the economic data this week, especially that Friday's non-farm payroll report. The government's job report, you're expecting 168,000 job ads. That is right on the historical average for the U.S. economy. Now, if you start to go under 160,000, let's say we come in at 140,000, that's not bad. That's actually not bad at all. You're still adding 140,000 jobs. If you go under 120, that's not great. If you go under 100,000 job ads, pretty shortly, you're going to start seeing real recession fears because under 100,000, you're getting pretty close to going negative. So as long as we stay above 140,000, I expect the markets are going to take that as good news. Again, under 100,000, you could be in for a 2 to 3% sell-off in your broader indexes. If the jobs report comes in 170 plus thousand, you could be in for a similar move to the upside. A 2 to 3% upside rally is what I would expect. And again, good news is it's not going to take long before we have an idea of where the Friday's jobs report is going to be, because the ADP employment change, whether it comes in way higher than expectations or way lower, is going to give us a pretty good insight on what to expect Friday, and it will move markets' expectations for that Friday number. Tesla stock specifically got absolutely disrespected around the 100-day moving average at $241.55. I wanted to see the stock hold support at that level, but as some people noted, $236 per share did hold support. I don't think that's nearly as relevant as the 100-day moving average, but to a point, that's an important level as well. Really, you want to stay above 230. If you break under 230, well, this was a demand zone from November all the way through December. For a month straight, you traded above 230 and you bounced off of 230 many times. If you break under 230, we're in for bigger downside potentially in the broader markets. And honestly, right now, it's hard to say if we will hold 230 or not. I want to say we will, but if the jobs report is bad, then we're not. We're going to fall. All in all, I still expect Tesla stock is going to do very well in 2024. If we go into a recession, then I expect Tesla, my bear case is around $200 per share. So you could see more downside from here. If it starts to look like we're heading into recession, the economy is slowing down, $200 per share would be a very good buy point for Tesla stock for 2024. My base case is $450 per share. That's if Tesla's margins improve. That's if Tesla can meet Wall Street's estimates. That is if we avoid a recession and can see some rate cuts and get some multiple expansion. Let's say EPS at $4.50 with 100 times multiple, you are at $450 per share in that theoretical example. That's still my estimate. That's still my base case. So quite an upside move from here is still what I'm expecting. But what could actually happen is we could have a very weak first half of the year and a very strong second half of the year as we get more clarity on the economy, whether or not we enter a recession. And by then we should be seriously starting to get some maybe large rate cuts. That's because 6-month annualized inflation is under 2%. So give it another 6 months, as long as we don't see a spike in inflation, you're going to be under the Fed's 2% target. That will allow the Fed to aggressively start cutting rates, whether we avoid a recession or not. Something that is also pretty strange that is happening under the surface, at the same time Tesla stock is declining over 4% today, the option activity from hedge funds and institutions is remarkably positive. I mean, you had 943 orders today, totaling $4.63 billion. That is about half of any given's total week's worth of option activity in a volatile week for Tesla. So normal option activity is like $1 billion. So this was about almost 500% higher than average. You still had a positive order value of 60%. Positive orders could be buying calls or selling puts. Negative orders would be buying puts or selling calls. So 60% positive. Well, that's very good. It's actually better than the total option activity for the day in Tesla, including retail investors. So hedge funds and institutions might be a little bit more bullish right now on Tesla than even retail. Total option activity today was 53.5% to the call side, 46.5% to the put side. Also worth noting on StockTwits, sentiment for Tesla is extremely bullish at 78, and message volume is extremely high at 80. So it does seem like investors overall pretty bullish on Tesla. And it seems like the narrative is, well, we're buying the dip in Tesla stock. So we will see what comes next. I'm still leaning bullish here because I don't think the economy is rapidly entering a recession, but I don't have those definitive answers. I don't know what the ADP employment change is going to be tomorrow. I don't know what the non-farm payroll report is going to be on Friday. If those numbers come in bad, you're going to see a lot more downside for the markets, considering the markets themselves are trading pretty much at all-time highs, and you're coming off of a massive rally from the lows in October. All in all, still, you're up about 37.5%. Could you give 10% of that back? Of course you could. That's really the big question. Recession or no recession? And what we heard from the Fed today was, well, the risk is that we do head into a rapid deterioration in the economy. I do think what makes the most sense is taking this red in the markets to buy more Tesla stock, to acquire larger positions in your favorite names. Because, I mean, odds are, what it's looking like right now, the first half of 2024 is going to be very uncertain until we get earnings out the way, and that's going to lead all the way through February, until we get more economic data that shows whether or not we're heading into a recession. The first half of 2024 could be rough. The second half of 2024 could be a little bit better, especially as we get inflation that's likely under 2% by the end of 2024, as we are getting aggressive rate cuts and as we have more clarity on the economy. If we do head into recession, how deep is it? If we don't, well, how strong is the economy? Those questions I don't know will be answered in the first half of 2024. But after all, I don't have all of the answers. Again, these are just my thoughts that I'm sharing with you guys. Hopefully we are correct in these assumptions, but if we're not, hey, that's fine as well. Let me know down below in the comment section what you think about today's decline in Tesla stock and the broader markets, and what are you doing in your portfolio? I did go on a buying spree today. Let me tell you, I put about $5,000 into the markets today alone. If you guys want to see all of those buys, check out that link down below in the description of this video. Come trade with us. We're doing it all. We're doing options trading, hedging portfolios, going long, doing some risky bets here, some safer bets here, relatively safe bets. You could lose all of your money on any given options trade, so don't let me say anything safe. You could lose all of your money plus some. But if that sounds appealing to you, come join the trading community. Link down below in the description of this video. You guys have a fantastic rest of your day. Maybe it's time for a cold one after a day like today. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.